Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing world of business and finance, and today we are diving into an 8. K filing from HCA Healthcare Incorporated to see if their recent financial maneuverings are a cause for celebration or concern. Get ready because this report might just have some very interesting numbers to unpack before we jump in. If you enjoy getting straight to the point insights from these massive corporate reports, make sure you are subscribed and have notifications turned on. We also have a Thrive Discord community linked in the description below where we discuss these filings and more so. Come join the conversation. Alright, so HCA Healthcare Incorporated is back with another big announcement. This time it revolves around a pretty substantial debt issuance totaling $3.25 billion. This happened on the 31st of October of 2025, but the prospectus supplement that paved the way for it was dated the 27th of October of the same year. So what exactly did they do? They issued a whole bunch of senior notes, and when I say a whole bunch, I mean a lot of money divided into 4 different tranches each with its own interest rate. And due date, it looks like they are borrowing money for the long haul here with notes maturing all the way out in 2055. That is like planning for retirement for your grandchildren. This is a classic move for large companies to raise capital for various needs, possibly expansion, paying off other debts, or just beefing up their cash reserves. First up, they've got $500 million of notes that mature in 2030. These come with a 4.300% interest rate. Then there are $1 billion in notes due in 2032 with a 4.600% interest rate, and another $1 billion maturing in 2035 carrying a 4.900% interest rate. Finally, rounding it out is $750 million of notes that don't come due until 2055, and these have the highest interest rate at 5.700%. Now, importantly, these notes were issued by HCA Inc., which is a direct wholly owned subsidiary of the main company HCA Healthcare. Incorporated, of course, the main company is acting as a guarantor, meaning they are promising to pay back this debt. If the subsidiary somehow can't, this is a common structure to isolate debt or for other legal reasons. But it means the parent company ultimately stands behind this massive loan. The actual agreement governing these new notes is a bit complex. It is built upon an older indenture from August 2011 and then amended and supplemented by 4 new ones, all dated the 31st of October 2025 one. For each series of notes, these documents lay out all the nitty-gritty details about how the notes work, including things like interest payments and what happens if things go wrong. The notes are set to mature on different dates with interest paid every 6 months, usually May 15th and the 15th of November. The first interest payment for these new notes is scheduled for May 15th of 2026. So they are giving themselves a little breathing room before the interest payments start flowing. When we talk about how this debt ranks, it is important to understand that these are senior unsecured obligations. This means they are higher in line for payment than any subordinated debt the company might have, but they are equal to other senior debt and effectively lower than any debt that is backed by collateral or assets. Also, they are structurally subordinated to any debt owed by HCA's subsidiaries, meaning if a subsidiary goes bust, the note holders don't get paid from that subsidiary's assets directly. As I mentioned earlier, these notes are fully and unconditionally guaranteed by the parent HCA Healthcare Incorporated. This is a strong sign of support and confidence from the parent company in these new debt issuances. Now let's talk about the rules and restrictions attached to this debt. The indentures contain covenants, which are basically promises HCA made. These limit their ability to, among other things, create liens or give certain assets as collateral for other debts, and also restrict certain sale and leaseback transactions. They also have rules around merging or selling off substantial parts of the company. These covenants are pretty standard, but they do put some guardrails on HCA's financial flexibility. The company does have the option to redeem some or all of these notes at certain prices. This means they can choose to pay back the debt early if they find it beneficial, perhaps if interest rates fall significantly. Here is an interesting one. There is a provision for a change of control if there is a significant shift in who owns or controls HCA Healthcare Incorporated, and there is a corresponding ratings downgrade, then note holders have the right to demand their money back, plus a little extra. This is a protection for investors in case a new owner changes the company's direction in a way that might reduce its ability to repay debts. And of course, like any debt agreement, there are events of default if certain bad things happen, like failing to pay interest or principal or violating other terms in the indenture. The notes could become immediately due and payable. This is a standard but critical part of any borrowing agreement. This massive debt issuance didn't just happen. They officially entered into an underwriting agreement on the 27th of October with several major financial institutions acting as underwriters like J.P. Morgan Securities Incorporated, Citigroup Global Markets Incorporated, Mizuho Securities USA LLC, and Wells Fargo Securities LLC. These firms helped HCA sell these notes to investors. This agreement basically outlines the terms under which the underwriters purchased the notes from HCA with the intention of reselling them. to the public. This underwriting agreement is a key piece of the puzzle because it solidifies the deal and the responsibilities of all parties involved. It is a substantial contract setting the stage for this major capital raise. We've linked this agreement as an exhibit for those who want to dive into the legal specifics. And finally, to add a layer of legal assurance, we have an opinion from Cleary Gottlieb Steen and Hamilton LLP. This is a big law firm, and their opinion likely covers the legality of the note issuance and the guarantees provided by the parent company. It gives investors more confidence that everything is above board legally speaking. So let's put on our Warren Buffett hat and take a look at this. What does this $3.25 billion debt issuance really mean for HCA Healthcare Incorporated on the surface? It is a massive capital raise. This indicates HCA is likely confident in its future growth prospects and ability to service this debt. They might be looking to fund ongoing operations, expand their facilities, acquire more. Spittles, or simply fortify their balance sheet against potential economic headwinds. The range of interest rates from 4.3% to 5.7% suggests a few things. Firstly, the longer the maturity, the higher the interest rate, which is completely normal as investors demand more compensation for locking up their money for longer periods. The fact that they can secure these rates, especially for the longer terms, indeed. They are still seen as a relatively low risk borrower in the eyes of the market, especially given the current economic climate. However, taking on this much debt is not without its risks. A larger debt load means higher interest expenses, which will eat into HCA's profits. It also means less financial flexibility in the future if they need to raise more capital or weather an unexpected downturn. The Cove. Ants mentioned in the report, while Standard do limit some of the company's future strategic options. Things like selling off assets or taking on more secured debt will now be more complicated. What is interesting is the timing of this filing coinciding with the date of the report, the 31st of October 2025. This suggests a very quick turnaround from the underwriting agreement on the 27th. For the issuance itself, this implies a high level of preparedness and a clear need for this capital from HCA's perspective. Looking deeper, the company is essentially leveraging its current financial strength to secure funds for future endeavors. This is a common strategy for established companies like HCA Healthcare Incorporated, but it is crucial to monitor how effectively they deploy these funds and how it impacts their profitability and overall financial health in the coming years. The real test will be whether the returns generated from whatever this money is used for will outweigh the cost of borrowing. In conclusion, HCA Healthcare Incorporated has made a significant move by securing $3.25 billion in new debt. This shows ambition and a need for capital, but also reduces a considerable financial obligation. The success of this maneuver will hinge on HCA's ability to prudently manage this debt and successfully execute its future business strategies. The company's direction appears to be one of aggressive growth funded by debt, which is a strategy that can pay off handsomely, but also carries significant risk if they can effectively utilize these funds to increase revenue and profitability. This could be a masterstroke, but if growth falters or unexpected challenges arise, this debt could become a heavy burden. What do you all think about this massive debt issuance from HCA Healthcare Incorporated? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives, and don't forget to check out our Discord server linked in the description where we can chat about these filings and much more. Thanks for watching, and I'll see you in the next video.